Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market webinar. If you're joining us for the first time, please take a look at the disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker dealer. If you're searching for investment advice, please reach out to a licensed representative. This show, as all our shows, are for informational purposes only concerning Market Chameleon tools and products. With that, Dee, good morning.
Good morning, Will. How are you?
Good.
And I'm going to share my screen here. And today we're going to discuss implied volatility rankings and how we could screen for implied volatility rankings and how to use implied volatility rankings for options. So we're going to start with this particular page here, the options implied volatility rankings report.
I know we're going to get a question on how you got there.
Yeah. So under options, if you go implied vol rankings over here, it's the second one down, click on that, and you will land on this page. And this is to follow up on some questions we had regarding implied volatility rankings and how do you measure them. And some people look at the implied volatility rankings, let's say, on one platform, but it doesn't match up on a different platform. So let's just discuss it to understand what's going on and how we could screen it and how do we benchmark it, because that becomes important in your total evaluation. And I'm going to first go over from left to right this table, and we have, as you can see, you have different filters above this table, and then you have a table with data and analytics that you could sort, screen, narrow down. And if we're going from left to right, here we just have this, just stock details. You see the stock symbol with the stock name, stock price, price change on the day, and market cap. So I'm just going to sort this by market cap. And when you click on the column heading, it will sort from lows to highs or highs to lows. So we'll go from highs to lows. Now you can see that this table changed. We have NVIDIA on top, then Apple, Microsoft, and so on. Then going further along, when we look at the implied volatility, a stock itself doesn't have an implied volatility. Implied volatility is derived from option prices. Okay, so that's where the implied volatility comes from. So if there's a stock, for example, and there are no options to reference, then we don't know how to figure out the implied volatility. The implied volatility is option pricing model where you put, you put certain inputs into the option pricing model, and then you're going to get this implied volatility output. And when we talk about the options, well, stocks, have options listed for different expirations, for different strikes, and those individual options also have a bid, it has an offer, it has a call, it has a put on the same strike, and they'll produce different implied volatilities. Right? So you could have lots of implied volatility numbers because there are lots of different options and bids and offers to run through the option pricing model. And also these options, when the stock moves around, that makes a difference too, because then you're not referencing the same option. In other words, like an option could be an at-the-money option, but if the stock moves very far away from that strike, it has a big move, well, all of a sudden that option that you referenced, it's no longer an at-the-money option. It could be an out-of-the-money option. It could be even so far out of the money, they'll have no bid at a penny. And the option, as you move from day to day, there's different days to expiration. And an option that you referenced today could have 30 days to left to expiration, but in 2 weeks it could have 15 days left to expirations. And you're at that point you're comparing something different, right? And because of that, to create an implied volatility benchmark, we have to kind of create a benchmark that we could track from day to day, but it's a similar methodology. Are we tracking a 30-day option that is at the money? Are we tracking a 10-day option that's at the money? Are we tracking a 10-day option that's 10% out of the money? We need to come up with some way to standardize that. So when we're tracking from day-to-day changes, or we're looking at historicals, we're looking at something that's similar. And in this case, what we're doing is looking at a IV30. And IV30 it's a 30-day constant maturity option. That's 30. And this is looking at an at the money option. Okay, so based on that, we can't just pick an option and track that specific option, because it's not going to stay 30 days to maturity consistently or at the money. So we have to come up with a methodology to calculate that. And that's based on a weighted average of expirations that straddle 30 days and a weighted average of options that surround the at the money. And we use this methodology so it's consistent. And then we could track that benchmark and how it's moving from day to day. So it's a methodology, just like, S&P 500 there's a calculation to calculate that, and you're tracking that calculation. The VIX is a methodology, right? It's referencing the SPX options, and it's doing all sorts of things to create that calculation. So now that we have this IV30 and we understand, okay, what are we referencing here? 30-day constant maturity of options that surround that the money. And we get this number. So for NVIDIA right now, it's 55. For Apple, it's 18.7. Microsoft, it's 18.6. That's the implied volatility. And now what do we do with it? Right? The question is, okay, now we have these different implied vols, and we might have several questions related to this implied volatility. One is, well, did it go up or down today? Just like a stock, what is it doing today? Right? Did that value move higher or lower, and by how much? So that's what this percent changes. This is looking at where did this benchmark IV30 close the previous day, right? Just like a stock, right? Where did it close at the previous day end of trading? And then it compares it to the most recent IV. So throughout the day, we're recalculating it, and then we're looking at the change. Did it go up or down from the previous day, and by how much? So in NVIDIA, it went up 1.1%. In Apple, you could see that went down 1.1% from the previous day. So this allows us to quickly understand, where, the implied volatility, or how the options are reacting based on this benchmark, and to what magnitude. And we could also look at the differences in some of, based on how we screen this is by highest market cap, how the other options are reacting. So this is a mixed bag, just looking at it. Some stocks implied vols went higher, some went lower. So at least in the top 10 biggest market cap stocks, we don't see that they're all moving in one direction together yesterday. Okay, up or down. how else can we measure this implied volatility? And when we look at the current level, the next question will be, well, how does this current level measure up to where it usually, or normally trades for this specific stock? Because stocks have different liquidities, trade differently, have different volatilities. So NVIDIA right now has an implied volatility of 55, and Apple has an implied volatility of 18.7. So we know NVIDIA's implied volatility is higher, but that doesn't necessarily mean that specifically for NVIDIA, this implied volatility is high. On a relative basis, for NVIDIA, it could be normal or even low. And for Apple, 18.7 doesn't necessarily mean it's low, because on a relative basis for Apple, it could be on the high end because that stock trades at a different volatility. So we'll need to start comparing this to something. We need a relative value to compare it to. And you could create these benchmarks, and there's certain standard, just like the IV30, it's kind of an industry standard to look at the 30-day constant maturity. And that's because historically we didn't, before we had weekly options and dailies, you usually had, the expirations were based on monthly expirations, 30 days. So what are benchmarks can we compare this to get a sense of, are we high or low on a relative basis, right? Because that's how we could compare it, high or low. It has to be on relative to what, right? It has to be relative to something. So here are 4 different benchmarks. There's no one right benchmark. There's no, one benchmark that you could say you could use this and that's it. There's different ways we could compare it. Just like, let's just say you're trying to evaluate a home you wanted to buy, a piece of real estate. Well, how do you know if it's the high or low? Well, there are different ways you could try to measure that. You could look at the most recent sales and take an average of those. You could look at what's available for sale, right? Maybe not the ones sold, but the ones that sold I can't buy anymore. What about the ones that out there available for sale? You could do a relative analysis of, well, what if I built my own house, bought my own piece of land and rebuilt it? What would that cost me? So there are different benchmarks to reference, and even within those benchmarks, what data points do you want to use? So let's look at these 4 that we have in this table. So the first one is the 20-day historical volatility of this stock. How did the stock in the last 20 days, the most recent history, right? What does that volatility look like? And let's compare that to what the implied volatility is looking forward. So if we say the options are forward looking, and this is the implied volatility going forward, right? That's what the options are going forward. This is what the options are implying future volatility. Well, how does that compare to the most recent volatility, right? And how many days do we look at? So this is looking at the most recent 20 trading days. Okay, so we use 20 days because these are 20 trading days. The IV30 is looking at 30 calendar days, so they're close. Okay, it's a little bit closer together. So let's say 20 trading days. We see that it's 34.4. Okay, well, that 55 is above 34.4. So just given that, we see that the options are already implying that volatility going forward will be higher than the most recent volatility. And you could do the math here by 20 vol clicks, but as you see here, that's one benchmark. Okay, what about a longer history? let's just say that maybe volatility can move up, can move down in the short, but in the long term, it reverts to this mean, longer term mean. So what is the longer term mean? What is the 1 year history? Right. So we could compare that here. And here it says that NVIDIA in the last year moved at a 49 volatility. So this is looking at the volatility of the stock compared to where the options are implied. So this is closer, right? Now it's closer to its 1 year, but it's a little bit above. And so we could see it's closer to the long-term average. Maybe the last 20 days were just exceptionally low volatility, and the markets are saying we're gonna be closer to its longer-term average. It's a little bit above, but it doesn't look extremely above here. So then we could measure the implied volatility. So this is measuring the implied volatility versus actual underlying volatility, historical underlying volatility. But let's say that the options tend to be priced above or below actual volatility. Maybe that the options are just priced differently to compensate for something. Maybe there's something in there, that needs to compensate for shocking news or something that's unexpected, or just it could trade below its realized volatility. If there's a lot of traders using options to buy right or sell premiums, it could depress option prices to the point where the implied volatilities will trade below the realized vol. So let's look at it from the perspective of the implied volatility historically for the same benchmark versus today. Okay, so now we're comparing the usual 30-day IV to the current level 30 IV. And how do we do that? Well, there's different ways, and we have two ranking systems here, and these were, one of them was by request. So this first IV percentile rank, this is a percentile rank, and what it does is says the following. Okay, the averages could get skewed, because you could have one day. So this is looking at the last 1 years of trading, so 252 trading days, and it's saying if I took the last 252 observations, just like you would take like the closing price of a stock, right? But what if we did that with the IV level, and we sorted it from highest to lowest? Okay, so imagine 252 observations from the highest to the lowest, and then we want to see how many of those are below 55. That's what we want to see, because the rest would be above it. So the idea is, well, if 100% are below, that means this is right now we're at the highest level in the last year, right? And if we look at the previous 252, if this IV percentile rank is 0, well, that means there's 0 observations below the current level. That means everything prior to today was above the level. That means everything would have been above 55. So this IV percent rank, it's going to be between 0 and 100. Okay, that's always, it should be between 0 and 100. So what does 72% mean?
Hey, D,
Yeah.
we had a question from Stefan who just joined. He says volatility of the stock price or 1 year average of the IV30.
Wait, say that again.
It says volatility of the stock price or 1 year average of the IV30. Obviously, this is a delay, so I don't know what you were talking about when he's asking that.
Yeah. So maybe the historical volatility. So this historical volatility, one is for 1 year. That would be the volatility of the stock, not the option. This 1 year historical vol will be the historical volatility of the stock. This 20-day historical vol, that's the realized volatility, 20 days of the stock. Okay, on the underlying. The implied volatility, that's coming from the options. Okay, so we're comparing options implied volatility and the realized volatility of the stock in these examples. The
Perfect.
30, right, okay. So this 30 IV, this one here, that's looking at the current option prices. Okay, that's where this is. The IV 30 is looking at the current option prices. Um, so this IV percent rank, this is comparing the last years of data, historical data, versus the current price, versus the current IV low. That's what we're doing. We're saying, well, where's the current IV 30? 55. What percentage of the historical data falls below this? 72%. That means 72% of the days in the last year, implied volatility, IV 30, was below 55. Okay, 28% were above. So that's what this is. And instead, we do this the percentile rank because if we take the average, we could take the average, but the average could get skewed. So we just do the percentile of the observations, the days that were below the current level, just to get an idea how often did it trade below this or above this. Okay, that's 72%. So then we got this IV 30 52-week position. And this came from by request, so we added it. This was I think it's based on customers seeing maybe on the internet or YouTube a different methodology that they like. So we got this by request. And what this does is it looks at two numbers. It says, what is the lowest and highest IV in the last year? Okay, so let's say if the lowest IV is 10, the highest is 100, that's the numbers it uses. It doesn't look at anything in between. Okay, so it takes the lowest and highest, and it says, based on that range, lowest and highest, where does the current level fall? So if the lowest was 55.1, it would be 0. If the highest was 55.1, it would be 100. But it can go below or above too, because we're looking at the last 252 days, not including today. So if the last 252 days, if the low high was, let's say, 20 and 50, well, 55 would be above 50 even, right? It would be above the 100%. Okay. So in this situation, 42%, let me see. If you click it, it does take you to a, by the way, forgot to tell you, if you click on these, 42%, it'll take you to an implied volatility chart. So you could kind of see, where the implied volatility was in a chart throughout the year. So this is where we are now. And you could see how in the last year it's moved around. Okay. So this is just saying it's 42% of the way from the low to the high. Okay. That's what this 52-week position is. So it's another number that you could screen by or sort by. And again, it's just different. It's a different benchmarker methodology of trying to figure out, where the implied volatility level is from a historical level, from a historical perspective. So we might not have time for an actual filtering and screen today, but I'm just going to go, we could do that tomorrow, but just going over the next couple tabs. Here, we have the current option volume. This just lets you know how busy these options are. You could have an IV rank, but if there's not a lot of trading, that IV rank, or even IV level, it might not be as reliable, because as the wider the options, the less trading, the harder it is to get price discovery. So here we have the current option volume, gives you a sense of how much activity there's in trading. Open interest percent rank. This also we put in there because sometimes people know, well, where the implied volatilities and how much open interest do we have relative to histories. If the open interest percentile rank is high, it means there's a lot of open positions. There's a lot of interest right now. People are carrying risk in positions, which could influence, the future prices of these, because once you have positions on and people, when you have that, then it could involve people having to get out of positions, hedging positions, liquidating positions, rehedging. So the higher the positions, the more commitment, the more, potential for activity in these options. It's telling you something. So that's what the open interest percentile rank is. It tells you on a relative basis how much open interest are we seeing in the options relative to history. The 73% means that 73% of the days in last year open interest was lower, 27% was higher. So we're a little bit on the higher end. Lastly, when IV's implied volatility, when we haven't, when we're looking at it, there's certain things going forward that could influence implied volatility, especially if we see upcoming events that could cause the stock to move, right? One is earnings. So over here, we have a column that displays either the next upcoming earnings that we've detected. So this one you see in NVIDIA, November 20th, we're coming up with an earnings. So implied volatility probably should be on a higher end. So if the earnings just got released, we add that for a reference point. So in Apple, the last earnings was October 31st. So we're not seeing one coming up soon, because we just had one, right? But we put that because if you're evaluating, it's important to know, okay, so we just had an earnings probably in the next 30 days, that's not going to impact the options. And maybe that's why we're on the lower end, because the earnings came out, that uncertainty went away. In addition, there could be other events particular to the stock that they announced. We're going to be in a conference. We're going to have an investor relationship, something that they may announce that could move the stock. And if we detect it, we put it in here. For example, here in Microsoft, there's going to be an annual shareholder meeting December 10th. So something to keep in mind when you're looking at it, because whenever management talks or there are investors with questions, that something could be said that could potentially impact the stock. Maybe not, but there's still an opportunity there for a potential move in the stock. So that would be the event column. So I'm going to wrap it up there. We went over all the data points. Tomorrow, we'll use some of these filters to narrow down these group of stocks.
All right. Great job, Dee, as always. Another perfect webinar. Thank you so much. Thank you, Chameleons,